In 2025, Americans are using buy now, pay later services for everything from groceries to streaming subscriptions. The idea of splitting up your pizza delivery payment might sound like satire, but it's becoming a real option. Household debt has climbed to a record $17.943 trillion as of late 2024, and debt payments now eat up 11.5% of household income. Even as borrowing costs rise, people keep spending, often on non-essentials. Nearly 70% of U.S. GDP depends on consumer spending, yet the pressure is mounting. The question isn't just how much debt Americans have taken on, but what it means for the stability of the entire economy. The $20 trillion debt avalanche. Across the country, household debt has climbed to unprecedented levels. By the end of 2024, Americans owed a record $18.13 trillion, a 3.6% jump from the previous year alone. That's an average of $104,215 per household, up 11% since 2020. The bulk of this debt is tied up in mortgages, which now account for $12.594 trillion. The average American with a mortgage owes $263,180, reflecting the high cost of housing and the pressure it puts on family budgets. But mortgage debt is only part of the story. Credit card balances have surged, reaching an all-time high of $1.166 trillion. The average balance is $6,380, and delinquencies are rising. 3.25% of credit card loans are now past due, while nearly 9% are sliding into early delinquency. For many, minimum payments have become a monthly hurdle, with more households carrying balances from month to month than ever before. Auto loans tell a similar story. Total auto loan debt stands at $1.644 trillion, with the average new car payment at $734 per month. The cost of owning a car has become a major strain, especially as inflation pushes vehicle prices higher. Delinquency rates for auto loans have also crept up, now at 1.4%, and more borrowers are falling behind on their payments. Student loan debt continues to weigh heavily on millions of Americans. The total now stands at $1.606 trillion, with about 1 in 5 families carrying an average balance of $24,500. This burden shapes financial decisions for years, making it harder for borrowers to save, invest, or make major purchases. Medical debt, while harder to track, remains a persistent issue. 13% of Americans have medical debt in collections, with a median amount of $703. The impact of all this debt is clear in household budgets. On average, 11.5% of disposable income now goes toward paying down debt. This leaves less room for saving or discretionary spending and makes families more vulnerable to even small economic shocks. The Federal Reserve's stress tests suggest that if current trends continue, banks could face $150 billion in credit losses by 2026, a sign that risks are building well beyond individual households. The rapid growth of debt has not been linear. During 2020, stimulus checks and paused loan payments gave many Americans a brief reprieve, shrinking balances and boosting savings. But by 2021, that trend reversed as spending rebounded. People financed everything from home renovations to electronics, often using credit. By 2023, inflation forced more households to borrow just to keep up with rising costs, especially on everyday essentials. Economists warn that the structure of this debt makes the situation even more precarious. Unlike the 2008 crisis, when mortgage debt dominated, today's debt is spread across multiple categories: credit cards, auto loans, student loans, and new products like buy now, pay later services. This diversification makes it harder to contain systemic risk, as problems can emerge from several directions at once. Buy now, pay later (BNPL) services have added a new layer to the debt landscape. These products, which barely existed a decade ago, now account for a growing share of consumer borrowing. They often bypass traditional credit checks, making it easier for consumers to take on more debt without fully understanding the risks. At the same time, auto lenders have extended loan terms to 7 years or more, locking borrowers into long periods of repayment on rapidly depreciating assets. There's also been a shift in how people think about debt. More consumers, especially younger ones, see credit cards and installment plans as normal budgeting tools rather than last resorts. Banks and lenders have encouraged this behavior, raising credit limits and sending out record numbers of pre-approved offers. The average American now holds 3.7 active credit accounts, up from 2.9 in 2020, and 60% of new cardholders carry a balance each month. Despite a strong job market and rising GDP, much of the recent economic growth is built on borrowed money. Retail sales, car purchases, and even everyday expenses are increasingly financed through credit or installment plans. Underneath the surface, the numbers point to growing fragility. This shift in spending habits is visible everywhere, even in the smallest transactions. Financing fast food, how we got here. Financing fast food through buy now, pay later services has become a defining feature of American consumer culture in 2025. What began as a niche payment option for larger purchases has rapidly moved into the realm of everyday spending, including takeout and groceries. In just a few years, the number of BNPL loans issued in the US soared from under 17 million in 2019 to 180 million by 2021, with the total value of these loans jumping from $2 billion to over $24 billion. This dramatic shift didn't happen overnight, but reflects a convergence of financial technology, consumer demand for flexibility, and a changing relationship with debt. The appeal of BNPL is straightforward. Split a $14 burger order into 4 interest-free payments, and the financial sting seems to disappear. Behavioral economists call this payment decoupling. When costs are broken up into smaller amounts, the pain of spending is dulled, and people are likely to spend more overall. Research shows that consumers tend to increase their total spending by as much as 15% when using BNPL, compared to paying upfront. Food delivery services and retailers have capitalized on this, integrating BNPL options directly at checkout, sometimes even making it the default. For many, the checkout screen now offers the option to pay for a pizza or groceries in installments, normalizing the idea that even the smallest purchases can be financed. The rise of BNPL for food and other small purchases is closely tied to the demographic profile of its users. Surveys show that the typical BNPL user is younger, often Gen Z or millennial, living in urban areas and earning under $60,000 a year. These consumers are more likely to have multiple forms of existing debt, lower credit scores, and a higher reliance on government benefits like SNAP. For many, managing cash flow is the main reason for turning to BNPL, rather than making large purchases more affordable. This group is also more likely to shop online, research products, and sign up for recurring subscriptions, all of which feed into higher BNPL usage. Food delivery platforms and merchants have responded by making BNPL options more visible and attractive. Partnerships between BNPL providers and food delivery apps have made it possible to finance even a single meal. Some platforms use prompts like "just $3 today" to encourage installment payments, and features like Venmo's Slice It let friends split restaurant tabs into installments at the table. Meal kit services and coffee subscriptions have also jumped on the trend, with a large share of new customers opting for BNPL plans that stretch payments over several months. In some cases, users juggle multiple food-related BNPL plans at once, using short-term loans to cover routine expenses. This shift has not come without risks. BNPL products often bypass traditional credit checks, and many lenders have operated outside the full scope of consumer protection laws until recent regulatory changes. Late fees and unclear terms can turn a seemingly manageable payment plan into expensive debt. Studies show that only a small fraction of users read the fine print, and default rates for food-related BNPL plans have begun to climb, especially among younger and lower-income borrowers. Food delivery services report that missed payments and defaults are becoming more common, with collection rates dropping and delinquencies rising. The normalization of financing everyday purchases highlights a broader economic paradox. For many, using BNPL for food or coffee is less about convenience and more about necessity, a way to stretch limited funds across a growing list of obligations. Anthropologists and economists alike point to this as a sign of deeper financial stress. As more consumers rely on short-term installment plans to cover basics, the risk of falling into a cycle of debt increases, especially when multiple plans overlap and late fees accumulate. These patterns point to a changing landscape in American spending, where the boundaries between needs and wants blur and debt becomes woven into the fabric of daily life. The story of BNPL and fast food isn't just about technology or convenience. It's about how different groups navigate financial pressures in a shifting economy. To understand the full picture, it's important to look at how spending habits diverge across generations and how each group's choices reveal the underlying economic challenges they face. The Great Generational Spending Divide. One of the most striking features of the current economy is the widening gap in spending habits between generations. The Great Generational Spending Divide isn't just about age, It's about fundamentally different approaches to money, risk, and what it means to participate in the consumer economy. Baby boomers born between 1946 and 1964 still hold the majority of U.S. wealth and approach spending with caution shaped by decades of financial uncertainty. They make up 53% of national wealth, but just 22% of consumer debt. For boomers, value and trust matter most. They prefer in-store shopping, want to interact with knowledgeable staff, and will spend weeks researching major purchases. Nearly 8 in 10 pay off their credit cards in full each month, and most keep cars for over a decade. Their financial routines, maintaining robust emergency funds, prioritizing home ownership, and clipping digital coupons, reflect a mindset shaped by past recessions and the desire for long-term security. Generation X, born between 1965 and 1980, sits in the middle. Gen Xers are pragmatic, blending the caution of boomers with the digital savvy of younger generations. They account for a substantial share of household spending and are often juggling the costs of raising families. Gen X prefers transparency and performance over flashy marketing, and their shopping habits reflect this. They research online, read reviews, and frequently choose premium products, especially for major purchases. They're also more likely to use time-saving tools like curbside pickup and online scheduling. When it comes to debt, Gen Xers are methodical. Most read the fine print, compare rates, and prioritize paying off high-interest balances. Millennials, born between 1981 and 1996, are defined by flexibility and experience. They move seamlessly between online and in-store shopping, but their smartphones are the hub for research, browsing, and purchases. Millennials trust user-generated content and reviews, value sustainability and inclusivity, and are more likely to engage with brands that share their values. Convenience and instant access drive their choices, and they're comfortable using credit and BNPL services to smooth out cash flow. Experience spending, travel, dining, and entertainment often takes priority over material goods, and for many, the idea of treat yourself is more than a meme. It's a regular line in the budget. Gen Z, born between 1997 and 2012, takes this to a new level. Digital natives to the core, they expect brands to meet them wherever they are on social media, in apps, or in physical stores. They're the most likely to use BNPL services, with over half reporting regular use, not just for big purchases, but for everyday items like food, clothing, and concert tickets. Gen Zers have a higher intent to splurge than any other group, and they're more likely to make impulsive purchases, especially when influenced by social media or peer recommendations. For many, financing small indulgences is normal, and carrying multiple installment plans at once is common. Retailers and financial institutions have adjusted their offerings to reflect these divides. Boomers see targeted savings products and loyalty programs, while Gen Z is courted with influencer-driven marketing and frictionless payment options that turn any purchase into an installment plan. Even shopping environments are tailored. Traditional grocery runs for boomers, micro-convenience stores, and QR-coded displays for Gen Z. The differences extend to financial safety nets. Most boomers have retirement accounts and home equity to fall back on. Gen Z, by contrast, is less likely to have investments or emergency savings. This lack of a buffer helps explain why younger consumers are more likely to use credit and BNPL for necessities, not just luxuries. For them, debt is simply part of managing cash flow, not a sign of crisis. Social media further amplifies these patterns. Gen Z's haul culture and millennials' curated lifestyles drive peer-influenced purchases, while boomers remain largely unmoved by online trends. These behaviors shape not just what people buy, but how quickly money circulates through the economy. Younger generations spend at a faster pace, but a larger share of that spending is finance, making the system more sensitive to shocks. As these generational approaches to spending collide, the consumer economy faces new forms of volatility. The habits and safety nets that once stabilized household finances are eroding for younger groups, while older generations' caution slows the flow of wealth. This tension creates an environment where traditional economic policies have uneven effects, and where the psychological burden of inflation and debt lands differently depending on age. Inflation's psychological toll. As the cost of living steadily rises, the psychological impact of inflation has become a defining force in how Americans spend, save, and manage their finances. The numbers from mid-2025 are stark. 62% of people say their financial situation feels tighter than just a year ago, and only a fraction, 10%, report that managing money has become any easier. This widespread sense of financial strain is not just about higher prices, but about the subtle ways inflation shifts spending habits, emotional responses, and even the logic behind everyday decisions. The effects show up first in the grocery aisles and on restaurant receipts. Food prices have climbed 2.9% in the past year, outpacing overall inflation, while tariffs have pushed up the cost of essentials like clothing and household goods. A grocery trip that cost $100 in 2020 now averages $137, and consumers notice. Many respond by eating at home more often. 67% report doing so regularly, and by shopping sales or buying fewer non-essentials. But even as they cut back in some areas, the urge to maintain comfort and normalcy persists. More than 2 in 5 say they refuse to give up high-quality food or their usual self-care routines, regardless of budget pressures. This contradiction is at the heart of inflation's psychological toll. Faced with the erosion of purchasing power, many consumers shift from careful budgeting to what behavioral economists call compensatory spending. The drive to preserve familiar routines, even as prices rise, leads to a mix of austerity and indulgence. Some households aggressively hunt for bargains and cancel subscriptions, while others continue to splurge on premium groceries or wellness products. The mental calculation changes. Instead of asking, "Can I afford this?" people increasingly ask, "Should I get it now before prices go up again?" Payment methods reflect this shift. Credit cards and digital wallets have replaced cash for most small purchases, with 57% of transactions under $50 now charged to credit. The rise of buy now, pay later plans for everyday items further separates the act of spending from the pain of payment. Small purchases, coffee, takeout, streaming subscriptions, blend into the background, while larger expenses are increasingly broken into installments. Retailers reinforce this pattern by displaying dual price tags or defaulting to payment plans at checkout, making price increases seem less jarring and debt more routine. Wage growth has not kept up, with average hourly earnings rising just 1.7% and the consumer price index up 2.4%. Most workers feel like they are moving backward. This gap fuels anxiety and prompts more people to delay major purchases, switch to cheaper brands, or drop discretionary spending altogether. Yet at the same time, it pushes some to spend on small luxuries as a way to cope, a phenomenon sometimes called doom spending. The logic is simple. If money doesn't stretch as far, it makes sense to enjoy it now rather than watch its value erode. Tariffs add another layer of pressure. By the end of 2025, the average American household is expected to lose $3,800 in purchasing power due to higher prices on imports, with apparel and food among the hardest hit. The psychological effect isn't just about the loss itself, but about the uncertainty it creates. Households reallocate budgets, cut back on essentials in one area to cover rising costs in another, and adopt new habits that may persist long after inflation subsides. The emotional toll is visible in the way people talk about money. Financial advisors report that crisis budgeting has replaced long-term planning for many clients. Younger generations, in particular, are more likely to finance basic needs and treat credit as a permanent buffer rather than a last resort. Only a small share of millennials and Gen Z maintain emergency savings, yet these groups are also more willing to spend on non-essentials, seeing traditional financial advice as out of step with current realities. Retailers and lenders have adapted quickly. Installment plans and credit options are now integrated into the purchase of everyday goods, from diapers to pet food, quietly normalizing debt as a tool for daily survival. The longer inflation outpaces wage growth, the more these coping mechanisms become standard practice, making it harder for households to return to old habits even if prices stabilize. These psychological patterns have real consequences for financial stability. As consumers adapt to higher costs by leaning on credit and installment plans, the risk of falling behind on payments increases. The next challenge emerges not just in how much people owe, but in how they manage the growing strain on their budgets. The credit card reckoning. Credit card debt is now the central pressure point in American household finances, with recent data showing a sharp increase in both balances and delinquencies. In mid-2024, credit card delinquency rates reached 3.25%, the highest since the aftermath of the 2008 recession. This spike is driven mainly by non-prime borrowers, those with lower credit scores, who now account for a disproportionate share of missed payments. The average credit card balance has climbed to $6,380, up nearly $300 from the previous year, while interest rates on most cards remain above 20%. For many families, this means balances are growing faster than their paychecks, and minimum payments barely keep pace with accumulating interest. Generational differences shape how this burden is carried. Gen X holds the highest average balance at $8,870, nearly triple Gen Z's $3,148. Yet younger adults aren't immune. Many compensate with more active accounts and frequent use of credit to manage cash flow. Millennials, for example, average 3.4 active cards, and 61% of them roll over balances month to month. The risk isn't confined to any one group. Credit bureaus report that non-prime accounts are now defaulting at rates last seen during the Great Recession, with these borrowers representing 23% of cardholders, but 42% of new delinquencies. For those caught in the minimum payment cycle, the math is punishing. On a $6,000 balance at 22% APR, sticking to minimum payments could mean decades of debt and more than $11,000 in interest. Banks, after a period of looser standards during the pandemic, began tightening credit in 2024. But the earlier surge in subprime lending left many households exposed. Over a third of new credit lines in 2022 went to subprime borrowers, many of whom now struggle to keep up with stacked monthly bills. Self-employed households, which tend to have higher median balances, face added uncertainty as fluctuating income collides with fixed payment obligations. The median credit card balance across the country sits at $2,700, but this figure masks wide disparities. Some families carry six-figure card debt alongside mortgages, while others use credit to cover basic needs like groceries and utilities. Bankruptcy filings have risen, with Chapter 7 cases up 18% year-over-year in early 2025. Credit card debt appears in nearly three-quarters of these cases, often combined with medical bills or payday loans. Many filers describe impossible choices, juggling rent, utilities, and minimum payments, with no margin for unexpected expenses. Geography plays a role, too. Southern states such as Mississippi and Alabama report average balances well above the national norm, while major urban centers like New York and Los Angeles lead in total delinquencies. The data reveal that 45.2% of U.S. families now carry credit card balances, compared to 40.9% with mortgages. In effect, credit cards have overtaken home loans as the most common form of household debt. Changes in bank practices have contributed to the current situation. Since 2019, the average credit score for new card approvals has dropped from 716 to 683, and approval rates for subprime applicants have climbed. At the same time, card issuers have reduced credit limits and sent out hundreds of millions of pre-approved offers, targeting households already struggling with debt. Recent shifts in student loan policy have added to the strain. With the end of the student loan payment pause in late 2024, many borrowers now face monthly bills of $300 to $700, competing with credit card minimums for a place in the budget. Early data show that 38% of student loan holders missed at least one other payment within 2 months of repayment resuming, most often credit cards or auto loans. Many prioritize student loans to avoid wage garnishment, while credit card balances continue to grow. Inflation-adjusted credit card debt rose 7% in 2024, while other types of consumer debt remained flat. For many, cards have become a financial pressure valve, bridging gaps left by stagnant wages and rising costs. Median household income after taxes is $74,580, while the average adult owes $62,500 in total debt. The burden of high APRs and growing balances means that credit cards, once a tool for convenience, now function as a source of ongoing financial risk. Banks have responded by increasing their loss reserves and writing off more uncollectible debt. Charge-offs reached $18 billion in the first quarter of 2025, and card issuers now spend more on rewards than ever, hoping to keep consumers spending. But as more families hit their credit limits, the foundation of consumer-driven growth begins to look unstable. This pattern is different from the mortgage crisis of 2008. Instead of risk being concentrated in one sector, credit card debt now cuts across age groups, regions, and income levels. The Federal Reserve's latest stress tests consider scenarios where a spike in card defaults could ripple through the broader lending system. With more Americans rating their credit as poor, the warning signs are clear. As new pressures emerge and household budgets tighten, the impact of rising prices on everyday goods becomes even more pronounced. Tariffs, the hidden spending tax. Tariffs introduced in 2025 now operate as a persistent, often invisible tax on American consumers, quietly raising the cost of daily life. The average effective tariff rate has climbed to 22.5% levels not seen in over a century. These policy changes filter directly into retail prices, leaving consumers with little choice but to pay more for the same goods. Apparel prices are up 17%, grocery bills have increased by 2.8%, and new cars cost 8.4% more than before the tariffs were imposed. Even a basic television or a pair of sneakers now comes with a built-in surcharge, and these increases accumulate across entire household budgets. The auto industry offers a clear window into how tariffs work their way through the economy. Car manufacturers initially tried to absorb the 25% tariffs on imported parts and materials, but those costs have become too large to hide. General Motors reported $1.1 billion in tariff-related expenses in a single quarter, and Stellantis expects to pay $1.7 billion in tariffs this year. Those figures translate into higher sticker prices. Analysts estimate that the average buyer now pays $2,000 to $3,000 more for a new vehicle than they would have just a year ago. The same pattern appears in other sectors. Bicycles cost 12% more, cookware prices are up 9%, and children's toys see a 5% premium. Retailers often disguise these charges as sourcing fees or material adjustments, but the result is the same: higher costs for everyday purchases. Domestic manufacturers haven't been immune. While some companies have moved production to the United States, the cost advantages have not materialized for most consumers. American-made appliances are now 6% more expensive, as manufacturers pay more for tariff-affected components. In many categories, there are simply no domestic alternatives. Consumer electronics, for example, remain almost entirely imported, and the price impact is unavoidable. Even when shoppers opt for Buy American, they face higher prices. A washing machine assembled in Ohio now costs $80 more than a comparable model made overseas. Consumers have responded with new shopping habits that reflect the pressure on their budgets. Many now split their purchases between discount stores for essentials and specialty retailers for occasional splurges. Use of price comparison tools in-store has jumped, and more shoppers are buying smaller quantities of premium items to avoid the higher costs associated with bulk packaging. These strategies take time. Families now spend almost 3 extra hours a week researching prices and deals, trying to offset the impact of tariffs. The timeline of these changes is easy to trace. After the first round of tariffs in January 2025, electronics prices rose almost immediately, with smartphones costing $50 to $75 more. By spring, auto prices climbed as the next wave of tariffs hit industrial components. By summer, household goods and seasonal items like grills and sunscreen saw double-digit price jumps. Shoppers have responded by making fewer trips but spending more per visit, a sign that higher prices are changing not just what people buy, but how they shop. The trade-offs are increasingly difficult. Nearly 4 in 10 households now delay replacing basic items like shoes or coats to cover the rising cost of food. Others skip routine car maintenance to afford tariff-driven increases in household essentials. For many, these aren't optional sacrifices. They're a sign that budgets are stretched to the breaking point. The psychological effect is significant. Over 60% of consumers in tariff-affected categories say they feel trapped by prices they can't control or avoid. Small businesses face similar challenges. Lacking the bargaining power of large chains, they often have no choice but to pass higher costs directly to customers or absorb losses themselves. A bike shop owner in Brooklyn now pays $1,200 in tariffs on a $5,000 shipment of parts, leading to higher service prices for customers. Bakeries, florists, and breweries all report paying more for imported ingredients and materials, with limited options for substitution. On a broader scale, the economic drag is measurable. The Congressional Budget Office projects that tariffs will shave 0.4% off annual GDP growth, which amounts to a $115 billion loss each year. Most workers report that any pay increases they receive are quickly outpaced by the rising cost of goods. The cumulative effect is a slow erosion of purchasing power, with households losing ground even as they try to adapt. Retailers have found ways to turn tariff anxiety into new revenue streams, offering extended warranties and price guarantees marketed as protection against future increases. Even second-hand stores are promoting pre-tariff pricing as a selling point. Meanwhile, some manufacturers have shifted assembly to other countries in an attempt to avoid tariffs, but this often results in further cost increases and no real benefit to consumers. What began as a shift in trade policy now shapes the daily decisions of millions of households, influencing everything from grocery lists to major purchases. The pressure of higher prices has become a permanent feature of the consumer landscape, and families are forced to adjust in ways that ripple through every part of their financial lives. As households adapt to these new realities, another force is quietly reshaping how people pay for the things they buy. The subscription economy trap. The subscription economy has quietly become a defining feature of household budgets. The average American now manages 12 active subscriptions, up from just 4 a few years ago. What started with streaming services and music apps has expanded into every corner of daily life: cloud storage, fitness apps, news sites, and even premium weather forecasts. Each service is designed to feel like a small, manageable expense, but together they add up quickly. For many, it's no longer about owning products or media. It's about renting access, one recurring charge at a time. Subscription pricing relies on subtle psychology. The $9.99 price point is engineered to slip under mental spending alarms, encouraging signups without much second thought. The result: dozens of just $5 or just $10 charges that quietly drain accounts. Industry data shows the average household spends $324 per month on subscriptions, often without realizing it. Nearly 8 in 10 subscribers underestimate their total spending by at least 40%. Companies count on forgetfulness. Over 60% of subscription services default to annual billing with auto-renewal, banking on the fact that most people won't bother to cancel. As economic pressures mount, some consumers are pushing back. Churn rates for subscription services have climbed to 23%, up from 15% 2 years ago, as people conduct subscription audits and trim unused services. But companies don't make quitting easy. Gym memberships require paperwork and phone calls. Digital services bury cancellation options behind layers of menus. It's not uncommon to spend half an hour trying to cancel a service that took seconds to sign up for. These friction points are by design. The reach of subscriptions now extends into unexpected areas. Pet owners pay monthly for curated toy boxes. Home cooks subscribe to recipe databases. Even basic household supplies can arrive on a recurring payment plan. Some services have introduced subscription models for things that were once one-time purchases, like software or even refrigerator filters. The effect is a gradual shift from ownership to endless renting. Payment options have evolved alongside this trend. Buy now, pay later (BNPL) services now let users finance annual subscriptions in installments. On the surface, this makes expensive subscriptions more accessible, but the risks are clear. Miss a payment and steep retroactive interest kicks in, some as high as 29.9% APR. Early data shows that nearly 4 in 10 BNPL subscription users incur late fees, far more than traditional subscribers. These new payment models create feedback loops, where missing a payment on a subscription can trigger a cycle of debt. Behavioral economics explains why subscriptions are so sticky. The endowment effect leads people to overvalue services they already pay for, even if they barely use them. The sunk cost fallacy keeps subscribers attached to platforms they've long since stopped enjoying. Companies reinforce these tendencies with reminders about membership anniversaries or streaks, making cancellation feel like a loss. Generational patterns are clear. Boomers tend to keep a handful of subscriptions, mostly for news and utilities. Millennials and Gen Z, by contrast, often hold a dozen or more, including micro-subscriptions for digital perks and creator content. This younger cohort spends over $200 a month for access to services, many of which see little use. The proliferation of walled gardens, where companies bundle multiple services together, makes it even harder to leave. Canceling one subscription can mean losing access to an entire ecosystem of content or tools. Recurring charges also create budgeting challenges. Many subscribers have $40 or more in forgotten, zombie charges each month, payments for services they no longer use or even remember signing up for. These small, regular withdrawals add up, sometimes pushing accounts into overdraft and causing missed payments on other bills. In recent surveys, over 1 in 5 consumers reported missing a utility or credit card payment due to unexpected subscription charges. Industry leaders often claim that subscriptions offer predictable spending and convenience. In reality, they extract more money for less control. Where consumers once paid a flat fee for software or media, they now face indefinite monthly charges. Even ad-supported alternatives are losing ground, as most users choose pricier ad-free options to avoid interruptions. The psychology of recurring payments favors the provider. People are more likely to tolerate many small losses than a single large one, making it easier for companies to unbundle features and charge extra for each. Some services penalize inactivity, raising fees if usage drops below a certain level. Others automatically increase prices after a trial period, counting on inertia to keep customers paying. Subscription spending now accounts for nearly 9% of the average household budget, triple what it was just a few years ago. This steady drain leaves less room for other expenses and locks consumers into a cycle of recurring payments that's hard to escape. Regulatory efforts to make cancellations easier are underway, but the core problem remains. an economy increasingly built on perpetual access instead of ownership. The long-term effect is a shift in financial priorities. As more money is committed to recurring charges, less is available for savings, investments, or major life goals. For many, the promise of convenience has turned into a web of obligations, with each new subscription tightening the constraints on financial freedom. The cumulative impact of these small, regular payments is changing how households think about money and what's possible for their future. Student loans, the never-ending story. Student loans now sit at the crossroads of American household debt, shaping financial decisions for millions. As of the third quarter of 2024, student loan balances reached $1.606 trillion, accounting for about 9% of all household debt. The end of the federal payment pause in September 2024 brought a sharp reality check. With the on-ramp period over, delinquencies are expected to rise in the coming quarters, and many borrowers are already struggling to keep up with both student loan payments and other debts. Roughly 1 in 5 families carry student loan debt, with a median balance of $24,500. Younger borrowers under 35 are more likely to have educational debt, about 40% do, but their median balance is lower, at $18,000. The heaviest burdens fall on older Americans. Those aged 55 to 64 carry median balances of $41,000, often due to co-signing for children or returning to school mid-career. For many, these obligations now compete directly with saving for retirement or covering basic living expenses. The Society of Actuaries estimates that student debt reduces average retirement savings by over $100,000 for borrowers over 50. The impact of student loans extends far beyond the monthly payment. Millennials, who hold nearly half of all student debt, face delayed milestones, homeownership is pushed back, and family formation is often postponed. Census data links a significant portion of the homeownership gap between younger and older adults to educational debt. Women with more than $30,000 in student loans are 23% less likely to have children by age 35, and couples frequently delay marriage until their loans are under control. These ripple effects touch not just individuals, but entire communities and local economies. Degree choice plays a major role in how borrowers manage. Some fields promise high earnings, but demand even higher debt. Pharmacy graduates often owe over $170,000, while starting salaries lag behind expectations. Art history majors may leave school with $28,000 in debt and face modest job prospects. Even law and medical degrees, once considered safe bets, show cracks. A third of 2024 law graduates reported salaries under $70,000 while carrying six-figure debt. These mismatches between debt and income turn what should be investments in the future into long-term liabilities. Repayment options are supposed to offer relief, but the reality is complicated. Income-driven repayment plans cap payments at a percentage of discretionary income, but often stretch the repayment period to 20 or 25 years. Most borrowers in these plans aren't even covering interest, so balances grow over time. At the end of the term, any forgiven amount is treated as taxable income, creating the risk of a large, unexpected bill. Private loans, which make up a smaller share of total debt, tend to come with higher interest rates and fewer protections, and they are rarely discharged in bankruptcy. The resumption of payments has forced many borrowers to make difficult choices. Some skip utility bills or delay medical care to stay current on student loans. Auto loan delinquencies among student debtors have risen since repayments resumed, and servicers report a surge in calls from borrowers unable to juggle rent, loan payments, and other essentials. The pressure is especially acute for those with multiple types of debt: credit cards, auto loans, and mortgages, all competing for limited income. The psychological toll is significant. Surveys find that more than a third of indebted graduates regret their degrees, a rate much higher than among those who finished college debt-free. Financial anxiety is common, with many borrowers reporting stress, sleep problems, and even panic attacks triggered by payment reminders. For some, student loans have become a barrier to forming relationships or pursuing new opportunities, as the fear of bringing debt into a partnership or taking career risks outweighs potential rewards. Employers and policymakers have tried to respond. Some companies now offer student loan repayment benefits, matching payments up to a certain amount each month. Public service loan forgiveness and other programs provide hope for a subset of borrowers, but the process is often complex and eligibility requirements are strict. Meanwhile, calls for broad-based loan forgiveness or reform continue, but the underlying issues of high tuition and rising living costs remain unresolved. Student loan debt has become a defining feature of modern adulthood. influencing everything from career paths to family planning. As more borrowers confront the reality of long-term repayment, the emotional and financial strain is reshaping attitudes toward education, risk, and even daily spending. These pressures don't just affect long-term plans, they're changing how people cope with financial stress in the present. The psychology of doom spending. In a climate where financial stress has become a daily companion, doom spending has emerged as a defining pattern of behavior. This isn't about the occasional treat or a harmless bit of retail therapy. It's a deeper, more persistent response to uncertainty and anxiety. Doom spending describes the impulse to buy things, often small, non-essential items, as a way to manage feelings of stress, hopelessness, or loss of control. The dopamine rush that comes from making a purchase offers short-lived relief, but it rarely addresses the underlying anxiety. Instead, it sets up a cycle. Spend, feel better for a moment, then face renewed guilt or financial strain. This cycle is especially pronounced among younger generations. Surveys show that 39% of millennials and 37% of Gen Z admit to doom spending, a trend that has grown as economic uncertainty lingers. For these groups, the line between necessity and indulgence blurs. A $35 candle or an $8 latte isn't about luxury, it's about reclaiming a sense of agency, however fleeting. The feeling of scarcity, both real and perceived, leads people to seek comfort wherever they can find it. The paradox is clear. Those who feel least secure with their money are often the ones most likely to spend impulsively to regain a sense of control. The numbers highlight how widespread this has become. In 2024, spending on non-essentials rose 17% even as inflation squeezed household budgets. Credit card statements tell the story. Late-night food delivery, impulse shopping on apps, and recurring charges for digital comforts like meditation or streaming subscriptions. Behavioral research confirms that people are more likely to make a purchase than to sit with uncomfortable emotions, especially when the act of buying is as frictionless as tapping a phone screen. Retailers and platforms are acutely aware of this vulnerability. Social media feeds are filled with ads promising self-care or instant happiness, often targeted to users at their most vulnerable moments. Algorithms track search terms like stress relief or budget meals and respond with a barrage of treat-yourself content. Limited-time offers and low-stock alerts create a sense of urgency, nudging consumers to act before thinking. The rise of buy now, pay later services has only made it easier to indulge in these moments. Splitting purchases into smaller payments hides the true cost and makes each decision feel less consequential. The mechanics of doom spending are rooted in the brain's reward system. Each purchase triggers a dopamine release, reinforcing the behavior and making it more likely to recur the next time stress hits. Over time, this can become a self-reinforcing habit, similar to other forms of emotional coping. The ease of modern payment methods, contactless cards, one-click checkouts, and auto-renewing subscriptions removes the natural pause that cash or deliberate budgeting once provided. As a result, spending feels almost automatic, with little opportunity for reflection. Financial literacy alone does not protect against this pattern. Even those who understand the risks and know how to budget can find themselves caught in the loop. The emotional pull of a small purchase often outweighs rational considerations, especially when larger financial goals seem unattainable. For some, doom spending is a way to resist a future that feels out of reach. For others, it's simply a way to get through the week. The consequences are visible in household finances. Doom spenders carry more credit card debt and are more likely to fall behind on payments. Their savings rates are lower, and they report higher levels of financial stress than their more frugal peers. The short-term comfort of a purchase is quickly replaced by long-term anxiety as bills pile up. Even as the economy continues to grow, much of that growth is fueled by these small, emotionally charged transactions. Corporate earnings reports reflect the trend. Companies in beauty, food delivery, and even utilities note that mood-based purchases now account for a significant share of revenue growth. Retailers have learned to package everyday items as solutions to emotional needs, turning stress and uncertainty into steady streams of profit. The rise of doom spending is not just an American phenomenon. Across the globe, people living with inflation and economic instability report similar patterns. The combination of social media, easy payment systems, and a sense of collective anxiety has made doom spending a common response to modern stress. This pattern has created fertile ground for new forms of consumer debt. As payment plans and installment services become more ubiquitous, the line between a coping mechanism and a financial trap grows thin. The buy now, pay later bubble. While credit cards have long been the default way to borrow for everyday spending, The rapid rise of buy now, pay later services has carved out a new and riskier space in the consumer finance landscape. The BNPL market has exploded over the past few years. In 2019, the top 5 BNPL providers issued just under 17 million loans in the US. By 2021, that number had soared to 180 million, with the total value of these loans jumping from $2 billion to over $24 billion. BNPL is now everywhere, from online checkouts to brick-and-mortar retailers, and the appeal is clear. Instant approval, no or minimal credit checks, and the promise of zero interest, at least if you pay on time. BNPL's structure is deceptively simple. Instead of revolving credit, each BNPL transaction is an installment loan tied to a specific purchase, typically split into 4 payments over 6 weeks. The process requires little friction. Most users are approved in seconds, with only a soft credit check, if any, and the first payment is due immediately. The catch is that there's no comprehensive reporting to credit bureaus, so borrowers can stack multiple loans across different providers without lenders seeing the full picture. This opacity is a key risk. BNPL is particularly popular among younger, lower-income, and less creditworthy consumers, groups that traditional lenders often avoid. Surveys show that 20% of U.S. adults have used BNPL services, with usage rates higher among renters, women, and those with lower credit scores. The average BNPL user has several active loans at once, each with modest balances, but the combined effect can be substantial. For many, it's easy to lose track of payment schedules, leading to missed payments and late fees that quickly add up. While industry associations report delinquency rates below 2%, independent data suggests the risks are understated. About 15% of BNPL users have missed at least one payment, and among subprime borrowers, the share is even higher. Most BNPL providers do not report missed payments to all 3 credit bureaus, so a consumer could be juggling hundreds or even thousands of dollars in hidden debt with little visibility to outside lenders. This phantom debt means that when consumers apply for car loans or mortgages, their credit files may look clean even as they struggle with multiple BNPL obligations. Merchants are eager participants in the BNPL boom. They pay higher transaction fees, often 3 to 6%, compared to 2% for credit cards, because BNPL increases both conversion rates and average purchase size. Retailers have learned that shoppers spend more when offered the option to split payments, so BNPL buttons are placed front and center at checkout. Some stores even use discounts to steer customers toward installment plans, knowing that the higher spending more than offsets the fee. The business model depends on more than just merchant fees. Despite the zero-interest branding, late fees are common, ranging from $7 to $25 per missed payment. In some cases, interest can be charged retroactively if a payment is missed. These penalties are a major revenue source for BNPL providers, and the structure encourages habitual use. Many platforms offer rewards or increase credit limits for borrowers who pay on time, further incentivizing repeat borrowing. Regulation has lagged behind the market's growth. Until May 2024, BNPL lenders operated with minimal oversight, facing few of the consumer protection requirements imposed on credit card issuers. The Consumer Financial Protection Bureau now requires BNPL companies to follow some of the same basic rules as credit cards, such as investigating disputes and providing billing statements, but many gaps remain. Most providers still do not verify a user's ability to repay or offer hardship programs, and few report positive payment history to credit bureaus. These gaps allow users to accumulate debts across multiple platforms with little accountability. The behavioral design of BNPL platforms amplifies the risks. Payment amounts are small and spread out, reducing the pain of spending and making consumers more likely to buy impulsively. Research shows that BNPL access increases overall spending and reduces price sensitivity, encouraging purchases that might not otherwise occur. The result is a feedback loop. As more consumers turn to BNPL to manage cash flow or indulge in discretionary spending, the risk of overextension grows. There are also broader implications. As BNPL debt accumulates outside traditional credit reporting, it introduces systemic risk. Lenders and investors cannot accurately assess a borrower's total obligations, and the bundling of BNPL loans into investment products creates new vulnerabilities. While current delinquency rates are lower than those for credit cards, the structure of BNPL makes it harder to detect emerging problems until they are widespread. The expansion of BNPL has changed the way Americans shop and borrow, but it has also created pockets of hidden risk that could undermine financial stability. As these pressures build, the effects are not contained to individual households. They ripple outward, reshaping the economic landscape in ways that are only starting to become clear. The disappearing middle class. Even as new forms of consumer debt reshape the financial landscape, the American middle class finds itself under growing pressure from every direction. In 1980, the majority of adults lived in middle-income households, but by 2025, that share has dropped below half. The income range that once defined security, roughly $47,000 to $141,000 for a family of three, now covers less than 49% of the population. The result is a polarized economy in which the top 20% hold a commanding majority of wealth, while a growing segment of households rely on credit and installment plans to maintain the appearance of stability. The erosion of spending power is at the heart of this shift. Since 2000, middle-class incomes have barely kept pace with inflation, rising just 12%, while the costs of essentials like housing, healthcare, and education have soared by more than 75%. The median home now costs over 7 times the median household income, up from just over 3 times in the mid-1980s. For many, the idea of the middle class as a stable, attainable goal has faded into memory. The numbers tell the story. In cities like New York and San Francisco, middle-income families are leaving in large numbers, but the Midwest and South offer little refuge. Housing costs have doubled in some Midwestern cities since 2020, and nearly half of Texas's middle-class renters now spend more than 30% of their income on housing. This squeeze is not just about geography. Social and political consequences follow closely behind. As the middle class shrinks, communities lose the common ground that once supported social trust and civic engagement. Swing counties that were predominantly middle class at the turn of the century now show sharp declines, and surveys reveal a steady drop in the share of Americans who say most people can be trusted. Economic polarization feeds into political polarization, creating a feedback loop that is hard to break. Looking at the longer arc, the speed of the decline stands out. Other advanced economies have seen gradual shifts, but in the US, the middle class has lost ground at a much faster rate. The post-war boom that created a broad base of economic security has given way to an era where even full-time work does not guarantee stability. The nature of employment has changed. Factory jobs that once paid enough to support a family have been replaced by service work and gig jobs, often with little security or upward mobility. Personal stories illustrate the new reality. Public school teacher in Phoenix earning $52,000 finds that after covering rent, student loan payments, and health insurance, there's little left for anything else. A mechanic in Ohio making $68,000 cannot qualify for a mortgage because of high monthly car payments at steep interest rates. These are not isolated cases. They represent the new normal for many who would once have been solidly middle class. The foundation of consumer-driven economic growth has grown fragile. For decades, middle-class spending powered nearly half of GDP growth. But as this group shrinks, businesses are forced to choose between serving high-end luxury buyers or budget-conscious shoppers. Mid-range retailers and service providers are disappearing, replaced by discount chains and luxury brands. The so-called hourglass economy leaves little space for stability in the middle. Recent policy choices have made the squeeze worse. Tariffs, intended to protect domestic jobs, have instead pushed up prices on basic goods, especially in sectors like clothing and appliances. The burden falls hardest on lower and middle-income households, with the average family losing significant purchasing power each year. Wage growth has lagged behind rising costs, and the benefits of policy responses have been unevenly distributed. Generational pressures compound these trends. Gen X, now in their peak earning years, faces the dual responsibilities of supporting both children and aging parents, while carrying heavy student debt. Much of their spending goes to necessities and debt service, rather than the discretionary purchases that drive broader economic growth. Meanwhile, younger generations struggle to enter the housing market, with home prices nearly double what baby boomers faced at the same stage of life. Many rent indefinitely or move back in with family, delaying the household formation that once signaled economic progress. The rise of buy now pay later financing is a symptom of this broader squeeze. Major retailers now offer installment plans for groceries and other essentials, not as a luxury, but as a response to shrinking paychecks and rising costs. For many, splitting up an $87 grocery bill is less about convenience and more about necessity. Despite these realities, more than half of Americans still identify as middle class, even as their finances fall short of traditional benchmarks. This disconnect helps explain why consumer spending data can look strong even as savings rates decline and debt loads rise. Households are maintaining the appearance of stability by relying on credit, but the underlying foundation is eroding. This slow-motion unraveling of the middle class has broad consequences. As the center of the consumer economy weakens, the gap between luxury spending and essential spending widens, setting the stage for a new kind of economic paradox. The luxury spending paradox. Luxury spending in 2025 stands out as a contradiction in the broader landscape of financial anxiety and shrinking middle-class security. The luxury market is not just surviving, it's thriving, with global sales climbing even as essential spending remains flat for most households. High-end purchases, once the exclusive domain of the wealthy, have become increasingly common among middle-income earners. Nearly half of all luxury sales now come from households earning under $150,000, and the average luxury shopper spends $12,800 a year on non-essential goods, all while carrying credit card balances that regularly exceed $9,000. A major driver behind this paradox is the rise of aspirational spending. Social media platforms are saturated with images of luxury lifestyles, and the pressure to keep up is relentless. Influencers and celebrities present curated images of success, making high-end brands feel both aspirational and attainable. Gen Z and millennials, in particular, encounter dozens of luxury ads each day, often more than job postings, fueling a desire to project status, even when it means taking on debt. The wealth illusion takes hold. Buying a $900 designer hoodie on installment creates the sensation of prosperity, even as actual net worth stagnates or declines. Research shows luxury buyers consistently overestimate their wealth compared to peers with similar incomes but less conspicuous consumption. Debt-financed luxury is not limited to handbags or shoes. Luxury car makers report that nearly a third of new vehicles are leased or financed with extended terms, sometimes stretching to 72 months. High-end cosmetics and accessories are increasingly sold through buy now, pay later plans. Even fractional ownership of private jets is marketed as a monthly payment, blurring the line between access and ownership. The democratization of luxury, made possible by easy credit, allows anyone to look affluent if they're willing to borrow for the privilege. This shift is visible in spending patterns. Luxury shoppers under 35 are more likely to have subprime credit scores, and personal loans for lifestyle purchases have surged. Gig workers and freelancers are especially vulnerable. Many lease luxury vehicles or invest in expensive wardrobes to appear successful, even if these choices consume most of their income. The entertainment and influencer economies reward visible displays of wealth, making it rational, at least in the short term, to prioritize image over solvency. Even those with substantial incomes are not immune. Private bankers report clients with high six-figure salaries routinely financing luxury watches and renovations, treating home equity as a source of spending money. The focus has shifted from whether an item is affordable to whether the debt payments are manageable. This attitude blurs the distinction between asset and liability, as homes become collateral for luxury consumption rather than long-term security. Luxury retailers have adapted to this environment. They offer try before you buy programs, extended payment plans, and even in-store credit consultations. The message is clear. Access to luxury is less about wealth than about willingness to take on debt. This is reinforced by behavioral economics, relative deprivation, hyperbolic discounting, and identity foreclosure all play roles in driving consumers to spend more for the sake of status. The effects ripple through the economy. Luxury spending now accounts for a disproportionate share of consumer debt growth, and late payments on high-end purchases are rising. The trend is not limited to goods. Luxury real estate is increasingly financed with long-term loans, and buyers take on monthly payments that far exceed what their incomes would traditionally support. The market manufactures demand through scarcity and financial engineering, encouraging consumers to stretch for access rather than stability. What began as a marker of affluence is now a widespread phenomenon of affluenza, the pursuit of appearance over financial health. The luxury sector's apparent strength can mask deeper vulnerabilities, especially when so many purchases are debt-financed. When consumers prioritize visible status over emergency savings or long-term security, the risks are not just personal, they become systemic. These pressures are felt most acutely by those whose incomes are unpredictable, whose financial safety nets are thin, and whose social standing is increasingly tied to what they can show rather than what they can save. The gig economy trap. The gig economy now captures a growing share of the American workforce, but the trade-off for flexibility is often a deep sense of financial instability. More than a third of U.S. workers are engaged in some form of gig work, from ride-hailing and food delivery to freelance digital tasks. While these jobs offer the promise of setting your own hours, they come bundled with unpredictable pay, few protections, and almost no benefits. For many participants, the gig economy is less a lifestyle choice and more a last resort as traditional employment options shrink. Income volatility is the defining feature. Gig workers routinely see their monthly earnings swing by nearly 50%, compared to the relative stability of salaried employees. This unpredictability makes budgeting nearly impossible. When a slow week hits, 76% of gig workers report relying on credit cards just to cover essentials. The lack of a steady paycheck means financial planning is a moving target. Mortgage lenders reject the vast majority of gig worker applications, and even renting can become a challenge as landlords scrutinize inconsistent bank statements. Costs stack up quickly. Rideshare drivers and delivery workers pay higher auto insurance premiums, often face increased vehicle maintenance expenses, and must cover their own health insurance, typically at rates far above what traditional employees pay. Once you factor in app fees, taxes, and the cost of keeping a car on the road, a gross income of $45,000 can shrink to less than $30,000 in real take-home pay. The gig economy's promise of independence is offset by the reality of hidden expenses and little room for error. Benefits are almost entirely absent. Only a small minority of platforms offer any kind of health coverage, and retirement savings are rare. Just 11% of gig workers contribute to retirement accounts, compared to more than half of traditional employees. This lack of a safety net leaves workers exposed to even minor setbacks. A single illness or car breakdown can wipe out weeks of earnings, and there's no paid leave to cushion the blow. Stories abound of workers in their 60s and beyond still driving or delivering, financing medical costs with credit or installment loans. By now, pay-later services have become a lifeline for gig workers facing irregular cash flow. Many juggle multiple BNPL plans at once, using them to finance everything from gas and phone bills to groceries between paydays. Partnerships like the one between Klur and DoorDash show how deeply these products have penetrated gig work. Drivers can now finance even their meals between shifts. This reliance on installment payments is not about indulgence, but necessity. When income is unpredictable, spreading out payments is one of the few ways to manage day-to-day survival. The growth of gig work has far outpaced that of traditional employment in recent years, but the financial distress that accompanies it is evident. Gig workers are significantly more likely to use payday loans, overdraw their bank accounts, and carry high-interest debt. The flexibility often touted by platforms comes at the cost of working long, unpredictable hours just to make ends meet. Many find themselves cycling through multiple platforms, delivering food in the morning, driving passengers in the afternoon, and picking up odd jobs at night, simply to patch together enough income to cover basic expenses. Comparisons with traditional employment highlight the gap. Salaried workers operate with predictable pay schedules, enabling them to budget, save, and plan for the future. Gig workers, by contrast, face income swings that make saving nearly impossible. Their average savings rate is a fraction of what traditional employees manage, and long-term financial planning is rare. Unexpected expenses can quickly lead to debt spirals, and the stress of constant financial uncertainty takes a toll on health and well-being. Personal stories reveal the human cost. Many gig workers, like single parents balancing multiple platforms, spend a significant portion of their income just staying operational, paying for gas, vehicle repairs, and the tools they need to keep working. Medical debt, car trouble, or a sudden drop in demand can push them into bankruptcy or force them to take on even more debt just to get by. The cycle is self-perpetuating. As living costs rise and traditional jobs become harder to find, more people turn to gig work, only to find themselves trapped by the very flexibility that drew them in. Policy debates over worker classification and portable benefits continue, but meaningful solutions remain elusive. Gig platforms continue to classify workers as independent contractors, avoiding the costs of providing benefits or stable pay. Proposals for portable benefits and stronger worker protections have stalled, leaving gig workers to navigate a system designed for maximum flexibility and minimum security. This instability doesn't just affect individual workers, it ripples through the broader economy. Gig workers' erratic spending and low savings rates undermine their ability to participate as reliable consumers, yet the economy increasingly relies on their labor. As more people are pushed into gig work, the fragility of this model becomes harder to ignore. The consequences of widespread financial instability among gig workers are beginning to show up in unexpected places, hinting at broader changes ahead for the consumer landscape. The Retail Apocalypse 2. Retail in the United States is experiencing its most significant upheaval in decades. The so-called Retail Apocalypse 2 is not just a catchy headline. It's a structural change driven by the collision of economic pressure, technological convenience, and shifting consumer expectations. Store closures now number in the thousands each year, and the retail map of the country is being redrawn in real time. E-commerce's share of total retail sales has doubled since 2019, now accounting for more than $1 in 5 spent. The result is visible on main streets and in suburban shopping centers, empty storefronts, repurposed malls, and a growing divide between thriving online platforms and struggling brick-and-mortar stores. Consumers have adapted quickly. The average person visits physical stores less than 4 times a month, down from over 8 just a few years ago. Instead, most shopping happens online, with 18 digital purchases per household in a typical month. Mobile payment systems have become the norm. Services like Apple Pay, Cash App, and Zelle have seen explosive growth. The checkout process now takes seconds, with a fingerprint or face scan replacing the act of handing over cash. For many, the friction that once made spending feel real has all but disappeared. Retailers that survive this transition tend to cluster at the extremes. Discount chains are expanding rapidly, opening hundreds of new locations to serve budget-conscious shoppers. At the other end, luxury brands invest heavily in in-store experiences, personal stylists, exclusive events, and high-end perks that can't be replicated online. The middle market is shrinking fast. Mid-tier department stores account for the majority of recent closures, unable to compete on either price or experience. The consequences extend far beyond shopping habits. Commercial real estate is under strain, with declining mall valuations and widespread repurposing of retail space. Many former anchor stores are now fulfillment centers, processing the steady stream of online orders. This transition, though profitable for logistics companies, leaves gaps in local economies. Municipal budgets shrink as retail tax revenues fall, and once busy shopping districts lose their role as community hubs. In some towns, the closure of a single mall can mean the loss of a quarter of the local budget, with few options for replacement. Job losses follow. Each shuttered store eliminates local employment, and the new jobs created in warehouses or delivery services are not always a one-to-one replacement. Warehouse work pays more per hour, but often comes with harsher conditions and higher turnover. The shift in employment patterns changes the fabric of communities, with fewer opportunities for flexible, customer-facing roles and more reliance on physically demanding logistics work. Consumer behavior also reflects the new landscape. Online grocery sales have surged, with a majority of households now getting at least some food delivered. The rate of returns for online apparel purchases is 5 times higher than for in-store shopping, and even large items like furniture are increasingly bought sight unseen. Retailers absorb the cost of these returns, which eats into margins and forces further adaptation. By now, pay-later services have become embedded in the retail experience, especially online. These installment options now finance a growing share of e-commerce, and their presence at checkout encourages larger basket sizes and more frequent impulse buys. For younger consumers, flexible payment plans are not just a convenience, they're an expectation. Retailers that fail to offer them risk losing out to competitors who do. Tariffs and rising import costs add another layer of complexity. Physical retailers, with their higher fixed costs and less flexible supply chains, find it harder to absorb price increases. Many are forced to raise prices, which pushes even more customers online, accelerating the cycle of closures and consolidation. The gap between the profitability of online and physical retail continues to widen. Some retailers have managed to adapt, turning stores into showrooms or integrating online ordering with in-person pickup. Others struggle to find a model that works, experimenting with return desks or hybrid spaces that never quite recapture lost foot traffic. The most successful strategies focus on offering something digital platforms cannot: immediate gratification, personal connection, or unique experiences. The psychological dimension of this shift is just as important. Online shopping delivers instant rewards, tracking numbers, delivery notifications, and the anticipation of a package arriving at the door. For many, this replaces the satisfaction once found in browsing store aisles. The ease and speed of online purchases have normalized impulse spending, and the data show that households now spend hundreds of dollars a year on items they never would have bought in person. The transformation of retail is far from over. The landscape is splitting into two extremes: discount outlets and luxury boutiques on one side, logistics hubs and empty storefronts on the other. The middle ground, once the foundation of American consumer life, continues to erode. As the sector restructures, the effects ripple outward, shaping not just how people shop, but how communities function and what kinds of economic security are possible. The next pressure point is already visible in another corner of household budgets, where the cost of basic shelter is rewriting the boundaries of financial stability. The housing market time bomb. Pressure in the housing market is mounting, and the numbers behind it reveal why so many American households now see homeownership as a distant goal rather than an assumed step. Mortgage debt has reached $12.6 trillion, making up nearly 70% of all household debt in 2024. The average mortgage balance is $263,180, with the 30-year fixed rate hovering at 6.51%. For younger buyers, the challenge is even sharper. Gen Z and millennials face home prices that are almost double what baby boomers paid, even after adjusting for inflation. The median home price sits at $370,600, a figure that stands in stark contrast to stagnant wages and rising living costs. Affording a home now often means stretching every dollar. The average down payment is 14% of the purchase price, up from 9% in 2000. For many, saving that amount is complicated by student loans and rising rents, with 38% of would-be buyers under 35 citing existing debt as their main barrier. Even those who manage to buy are locked into higher payments. A $250,000 mortgage at today's rates adds over $100,000 in interest over the loan's lifetime. FHA loans, a common choice for first-time buyers, now carry rates above 7%, further raising the cost of entry. Renters are not spared from these pressures. The median rent-to-income ratio has climbed to 34% nationwide, well above the 30% threshold typically considered affordable. In cities like Miami and Los Angeles, households spend over 40% of their income on rent, not counting utilities or insurance. Landlords increasingly require proof of income 3 times the monthly rent, which means a $2,000 apartment demands a $75,000 salary, out of reach for many, given the national median income is around $56,000. The math doesn't add up for most, leaving renters with little room for emergencies or savings. Regional trends add another layer of complexity. Sun Belt cities such as Phoenix and Austin have seen home prices rise by 45% since 2020, driven by demand from remote workers and investors. In the Midwest, lower sticker prices are offset by high property taxes. For example, Chicago homeowners pay over 4 times the rate found in Honolulu. Even cities once seen as affordable now experience bidding wars and investor competition, making it harder for first-time buyers to get a foothold. Investor activity plays a significant role in shaping the market. Institutional buyers now account for a growing share of single-family home purchases, especially in fast-growing metro areas. These buyers often pay cash, waive inspections, and convert homes into rentals, pushing prices higher and crowding out local families. In some markets, investors own up to 20% of available single-family homes, creating a cycle where more properties become permanent rentals and fewer are available to buy. For many, alternative living arrangements are no longer a choice but a necessity. Multi-generational households have increased by nearly a fifth since 2020, as adult children delay moving out and older relatives move in. The tiny home market and vehicle living have grown, not out of preference, but as a response to being priced out. Even high earners are adapting. A third of renters making over $100,000 now have roommates to manage costs. The gap between home prices and incomes has never been wider. In 1970, a median home cost less than 3 times the median income. Today, it's more than 6 times. Mortgage payments now consume 35% of household income, compared to 22% in the mid-1980s. These shifts have widened generational wealth gaps, with older homeowners holding substantial equity and younger adults struggling to accumulate even modest savings. Rising construction costs, partly driven by tariffs on building materials, add to the problem. The price of building a new home is up by tens of thousands of dollars, ensuring that supply remains tight. Builders focus on higher-end projects, while affordable housing units lag far behind demand. Policy responses have failed to keep pace. Estimates suggest the country needs millions more units just to meet current needs. The psychological effects are visible in shifting life milestones. The average age of a first-time homebuyer has risen to 38, up from 29 in the 1980s. Nearly half of young adults live with parents or relatives, delaying household formation and the spending that typically follows. Social media is filled with stories of house hacking, van living, and other workarounds, reframing survival strategies as lifestyle choices. The housing market, once a pathway to stability, now functions as a sorting mechanism, transferring wealth from renters to owners, from the young to the old, and from families to investors. As the cost of basic shelter rises, more households are forced into trade-offs that strain every other part of their financial lives. The consequences of this time bomb extend beyond real estate, touching every aspect of economic and personal security. For many, the next financial challenge arrives in the form of a bill they never expected and often cannot pay. The healthcare spending black hole. Medical debt now stands as one of the most destabilizing forces in American household finances. Over 43 million Americans, about 13% of the population, currently have medical bills and collections. The median debt in collections hovers around $700, but in some states, it climbs past $900. These debts are rarely the result of elective procedures or luxury care. They stem from ordinary emergencies: a broken arm, an ambulance ride, a necessary prescription. Even those with insurance face steep deductibles and copays, often spending nearly 10% of their household income before coverage even begins. For many, the act of seeking care means weighing whether to pay the rent or fill a prescription. Insurance coverage, far from being a safety net, frequently exposes gaps. About 30% of insured Americans say they have put off care due to cost, while nearly half the uninsured avoid treatment altogether. The structure of the system creates impossible trade-offs. An unexpected illness can leave a family to decide between fixing a car or paying for a child's medication. These decisions don't just affect health, they erode financial security and drain savings, often pushing families into cycles of debt that are hard to escape. Healthcare costs have outpaced wage growth for years. Hospital prices rose 42% between 2010 and 2020, far exceeding overall inflation. Routine procedures cost multiples of what they do elsewhere in the world. An MRI that runs $500 in Europe might cost $3,000 at a US hospital. Even small items, like a bag of saline or a simple bandage, can be billed at a rate that would seem absurd outside the American context. These costs filter down to patients, who often receive bills they struggle to decipher, let alone pay. Geography plays a role in the burden. Southern states, many of which have not expanded Medicaid, show the highest rates of medical debt. In South Carolina, more than 1 in 5 residents has medical debt and collections, compared to less than 1 in 10 in states with broader coverage. The difference is not just policy, it's lived experience. A single mother working 2 jobs can see a $15,000 surgery for her child turn into a years-long debt spiral. Communities of color face disproportionate impacts, with 15% holding medical debt in collections. International comparisons further highlight the problem. The US spends nearly twice as much on healthcare as other wealthy nations, yet outcomes are often worse. Crowdfunding for medical expenses has become routine. Each year, Americans raise hundreds of millions of dollars online to cover basic care, something virtually unheard of elsewhere. Even with these efforts, medical bills remain a leading contributor to bankruptcy filings, with many filers reporting that a single illness or accident triggered their financial collapse. Collections practices frequently intensify the hardship. Hospitals often sell patient debt to third-party agencies, who pursue even small balances with aggressive tactics. Many patients report harassment over bills under $500, and lawsuits for unpaid medical debt can add legal fees that double the original amount owed. The system's complexity and lack of transparency put patients at a disadvantage. Even those who try to negotiate or pay gradually can find their credit damaged, affecting their ability to secure housing or employment. Mental health care and prescription drugs add further strain. Therapy sessions can cost hundreds of dollars each, and psychiatric medications may exceed $1,000 a month. The price of insulin has tripled in the past decade, and new treatments for chronic or life-threatening conditions often launch at 6-figure price points. Patients respond by rationing medications or skipping care altogether, sometimes with fatal consequences. Employers feel the pressure as well. The cost to insure a single employee now averages $16,000 per year, up sharply from a decade ago. These rising costs suppress wage growth and hiring, and small businesses are hit hardest. Many cite healthcare as their top financial concern, and some drop coverage altogether, leaving workers more exposed. Government interventions have provided only partial relief. Recent laws have curbed some surprise billing, and a handful of states have managed to keep costs lower through targeted programs. Still, many reforms face strong opposition from industry groups, and millions remain in coverage gaps. The system's structure continues to prioritize profit over affordability, leaving families to navigate a maze of billing codes, insurance denials, and shifting networks. Medical debt's effects ripple outward. Families delay buying homes, starting businesses, or having children because of financial uncertainty. Workers stay in jobs they dislike simply to keep their insurance. The economic cost is hard to quantify, but the result is clear. Healthcare spending has become a black hole, drawing in resources and limiting choices across the economy. When the cost of basic care can upend a family's finances, it becomes impossible to ignore the broader consequences. The cycle of spending, debt, and sacrifice is not limited to healthcare. It shapes the way Americans participate in the entire economy. The 70% GDP mirage. Beneath the surface of everyday purchases, the American economy depends on a single, outsized variable: consumer spending, which now accounts for nearly 68% of GDP. This figure is often cited as a testament to economic strength, but it obscures a deeper fragility. The so-called 70% GDP mirage reflects a system where growth is less about rising wages or productivity and more about an ever-expanding cycle of borrowing and spending. In 2025, GDP growth slowed to 2.1%, down from 2.8% the previous year, even as households continued to spend at record levels. This persistence in spending, despite stagnant incomes and mounting debt, raises uncomfortable questions about the sustainability of the entire model. Historically, the share of GDP driven by consumer spending has crept upward over decades. In the early 1960s, it hovered around 62%. The climb towards 70% didn't come from a sudden surge in prosperity. Instead, it paralleled a long period of wage stagnation, rising living costs, and the creation of new forms of household debt. Rather than saving for major purchases, Americans increasingly turned to credit cards, auto loans, student loans, and now, buy now, pay later plans. The result is a GDP headline that looks robust, but is increasingly underpinned by obligations that will eventually come due. The mechanics of this cycle are straightforward. As wages failed to keep pace with inflation, households made up the difference with debt. Credit card balances have reached $1.2 trillion, auto loans $1.6 trillion, and student loans another $1.6 trillion. Installment plans now account for a growing share of retail purchases, with nearly 4 in 10 transactions structured to delay full payment. This financial engineering props up spending figures, but it also means much of the apparent economic health is borrowed from the future. Inflation remains a persistent challenge. The Federal Reserve projects core inflation at 3.6% for 2025, and while some of this pressure is expected to ease, it continues to erode purchasing power. The introduction of tariffs in 2025 is expected to shave 0.5 percentage points off GDP growth and cost the average household $2,400 in lost purchasing power. Clothing and textiles are especially hard hit, with prices for some items rising 30% to 40% in the short run. These added costs further strain budgets, yet overall spending has not meaningfully contracted, another sign that debt, not income, is keeping the engine running. International comparisons highlight how unusual this model has become. In Germany, consumer spending accounts for just over half of GDP. Japan is similar. Both countries rely more heavily on exports, investment, and public spending to drive growth. The US stands out for having shifted the burden of economic expansion almost entirely onto the consumer. But when that spending is increasingly financed by credit rather than income, it introduces a vulnerability that is hard to ignore. The cracks are becoming more visible. Credit card delinquencies are rising, and personal savings rates have dropped to near historic lows. Many Americans now devote a significant share of their take-home pay to servicing debt, leaving little room for emergencies or future investment. At the same time, policy responses remain focused on keeping credit flowing, whether through lower interest rates or new lending products, rather than addressing the underlying gap between wages and costs. Tariffs and inflation have exposed the limits of this approach. As prices rise faster than incomes, households face a choice: cut back on spending or take on more debt to maintain the same standard of living. So far, the answer has been to borrow more, but there are signs this strategy is reaching its breaking point. The foundation of growth, consumer spending, looks increasingly unstable when it rests on shrinking savings and rising obligations. The 70% GDP mirage is not just a quirk of accounting. It is a signal that the American economy is running on momentum that cannot last indefinitely. When so much depends on the willingness and ability of households to keep spending, Even as their financial cushions erode, the risks become systemic. The illusion of endless consumer-driven growth is fading, replaced by the reality of slower expansion and greater fragility. As this model reaches its limits, the path forward becomes less certain. The next phase will test whether the economy can adapt, or whether the weight of debt, stagnant wages, and rising costs will force a reckoning. Looking ahead, the U.S. economy faces a period of slower growth and increased uncertainty. Consumer spending, long the backbone of economic expansion, is beginning to show signs of fatigue as elevated prices, tariffs, and higher interest rates eat into household budgets. Fitch Ratings projects spending growth will slow to just 1.5% over the next 2 years, a marked drop from recent years. With inflation expected to remain persistent and policy responses in flux, families are forced to make tougher choices about where their money goes. The reality is that debt and rising costs are reshaping the way Americans live and spend. As financial pressures mount, the gap widens between what households want and what they can actually afford. For many, the tools that once offered flexibility, credit cards, BNPL, and installment plans, now carry new risks. The system is reaching a point where the choices made today will determine whether economic resilience can be rebuilt, or whether more households will be left managing the fallout. For resources on managing debt and financial stress, check the description below.